Well, Northern Arc Capital is the next company in focus, and it's gaining on the back of robust set of Q1 numbers. My colleague Harsh Saita caught up with Ashish Mehrotra, MD and CEO of the company, and asked him about the highlights of the quarter gone by. Listen in.
We've had a very strong growth trajectory over the last 3 years. The growth is over 30% year on year, quarter on quarter. I think we should be able to ensure follow the growth as we've demonstrated in the past. So balance sheet has grown at about 32% odd. Our profits have actually grown better by about 43% on a year-on-year basis. It just demonstrates the quality of the franchise. And more importantly, the power of a diversification really shows you in times like this that you're able to grow across the sectors and ensure the flow of credit to the underserved sectors. And I think that's where it reflects both in terms of the balance sheet growth and the underlying performance.
And will this kind of mix continue? Is this how largely we'll continue to see the balance sheet with the 30% growth coming in? Or will you calibrate certain segments?
Obviously, we would have calibrated certain segments. Like I said, we are diversified. We focused on 6 sectors. MSME is the largest sector with about 39% of our balance sheet, followed by addressing the needs of urban poor through consumer finance, then micro enterprises through MFI, vehicle, affordable housing, and so on and so forth. So it's pretty well diversified across these sectors, across geographies and product. And that gives us the required tailwinds for us to ensure we are able to leverage on the opportunity which is there. And obviously, there is a big credit gap across these sectors, whether, access to credit is concerned with regards to urban poor, to regards to rural India, with regards to MSME. That means this provides us efficient growth opportunity. But we tend to be calibrated in our approach to ensure we are able to maximize the risk-adjusted return. To me, that's a very important metrics to look at it. As you're seeing some amount of headwinds across in some of the sectors. So our actually risk-adjusted return has improved from about 690 basis point to about 740 basis point, about 50 basis point improvement on our risk-adjusted returns. And that shows that if you are able to grow in a calibrated manner and pretty focused and leverage your data, your expertise, your technology, and look at the risk on a first principle basis, you will be able to get better outcomes.
Right. If I can break this up a little bit more, you have MSME and you have MFI. You also have vehicle finance. Just talk us through what part of your book is secured and what part is unsecured. And how is unsecured really behaving?
So I think the way to look at our business on 2 lines, and I'm going to take a minute to help you dissect this little better and peel the onion. So we lend to other intermediaries to ensure on lending. And then we also lend directly to the customers in the 6 sectors: MSME, consumer finance, microfinance, this means lending to rural India, vehicle finance, affordable housing, and agri supply chain. Our top 3 sectors, MSME, consumer, and MFI, constitute about 80% of our balance sheet. We also, at the same time, use this opportunity to provide credit solution to our other originator, which creates a sticky fee income. And we also invest through our AIF and PMS funds across these sectors. So we are able to leverage our knowledge of the sector, our data insights and lending performance book and technology to ensure we are able to play across the 3 lines of lending, placement solution or credit solution, and investment through funds. And that creates a very sticky fee income. So the balance sheet is pretty well diversified. Like I said, 39% odd in MSME, consumer finance is about 27%, MFI is now down to 22%, and rest is between the rest of the 3 sectors. Because our portfolio is well spread across 648 plus district, and touch and feel of risk, and our time-tested model ensures we are able to get better outcomes and have a head start when we see in terms of risk and performance across our peers. And that ensures that your return on assets, profits, and return on equity continues to get you a better outcome.
And Ashish, secured versus unsecured, if you can just touch upon that.
So large part of when we lend as an intermediate financier in our intermediate finance business, It's tend to be secured by the book debt or the charge on the assets, are pure unsecured on our balance sheet. And then when we lend through partnership, you have FLDG as per the new DLG guidelines of 5%. So pure unsecured on our book is less than 15%. Rest is secured either through an FLDG or through charge on the book.
Okay, take your point. And with regard to just housing finance, do you believe that you're going to grow that book, or you're going to focus on that book a lot more going forward? Because as a component of your overall, it's quite small now. So just trying to understand, how do you look at housing finance?
I think the more we look at housing finance in terms of providing these structured finance solutions through securitization and others, I don't know if you're aware, we are pretty innovative in providing structured solution through our perpetual securitization and the multi-originator securitization product. And that means we able to do a large amount of securitization to provide access to credit. In Q1 itself, I think the numbers been pretty good. About 2,600 crores would have just done through the placement business. That shows that the quality of the franchise is good, and that we are able to use our knowledge and data to find solution for other lenders and provide high quality investment grade books to investors for them to participate. As a consequence, create enough liquidity in the market for the flow of credit to happen.
And do you do gold loans at all, or aid third parties to do gold loans, or no?
Not, no, very.
Understood.
Very.
Understood. Okay, let me move to financial metrics. You've done 9% plus on margins this time around in Q1. Is that one sustainable? Two, does the IPO change anything with regard to margin numbers? Does it materially tweak up margin numbers temporarily thereafter as you leverage? Will it come off? What's the realistic picture?
This is Q1, so IPO happened week
Correct.
back.
Yes.
Money will come in now, so maybe part of that will show you a little bit of flip on the return on assets and margin. But the core margin on the business on a risk-adjusted basis, like I'm saying, is pretty strong and sustainable. So if you look at a NIM, actually went up from about 830 to about 910, and you can load that up by about 80 basis point of fee. I think the fee income in the coming quarter should improve. It tends to be a little bit seasonal because the credit demand goes up towards the H2 with festival seasons and all of that coming into as the spend goes up. Our sense is on a risk-adjusted basis, we should be able to hold and do better than 7.4%. And I think that's a very good number to look at it. And it's up from where it used to be 6.9 last year, same time. So if you have 50 basis point improvement on a risk-adjusted return, demonstrate that in a calibrated manner, understanding risk, you're able to generate a significant delta.
And OPEX to assets largely has gone up, also because you've done very sharp expansion. I would believe, from a physical presence perspective. Just talk us through that. What are the operating levers available to you?
So like I said, and I think our numbers hold broadly range bound, we ended last year with OPEX, in the way we look at it after adjust fees and commission, as about 4%. Q1 is at 410, so it's about 10 basis points. It's within the range bound. My sense is, the productivity is yet to kick in. Ideally, which we should get the required set of productivity to better it as we go forward. Overall, OPEX is broadly, for us, I don't see any stress on that line because we kind of invested pretty heavily in strengthening our technology proposition to ensure so much of quantum of credit which flows through us. Life to date, we've done like 1.8 trillion plus kind of enabling of credit. So I think that gives you a significant strength. The second, we expanded our branch footprint. So if you look at it on a 3-year basis, that you moved up from 280 to about 410, 110 basis point is essentially expansion. Now that you've done that over the last 18 months or so, you should start getting the productivity returns on top of it. So I'm pretty confident for us to be able to hold or better that number.
And with regard to credit costs, seen a bit of an increase. I understand there's also a one-off involved in this. Just break it down for us. What's the kind of outlook that you're looking at?
I think we've always been very prudent in looking at our risk, and I keep on saying in our strategy, A, we want to be a leading platform. B, we continue to broad base the franchise and build direct to customer business. And C, is our risk first principle, culture, cost consciousness is core to us in what we do, in these digital and data. So the change we made beginning of this year, we kind of updated our ECL model, and you see the increase is predominantly 60 basis point increases on account of a good book provisioning. So we created higher provisioning on a good book to ensure we remain within our ambit. But if you look at it on a GNPA basis, we broadly flat to where we were at about 45, 47 basis point, and net NPA maybe 5 basis point better. So you have to create a good book provisioning, ensure that your models are robust. Given that you're seeing some amount of stress, you and I spoke about it last time when we did. So it's ensure that you have a good provisioning available. We have in our stage 3 assets, we have over 74% provisioning. I think that's where it is.
Right. And just with regard to ROA, your ROA 3% plus, very strong. Sustainability and levers that you have, what's the kind of number that one can sustainably expect you to clock? And if at all it's higher, what are the levers that are going to get you there?
I think there are two interesting parts of an ROA piece. One is the NIM and the second is the fee. We have a unique fee proposition which comes from our credit solutioning of the placement business, and second from the funds, and eventually from technology and data. So if you look at it on a last year basis, that constitute about 100 to 110 basis point of fee income, which means if you look at a loaded NIM, even if I look at only for Q1 itself, from 9 to 10 basis point of NIM, you add 80 basis point of fee income, that gets you to close to 10%. And then you offset 4% OPEX, your 1.7% of credit cost, which includes 60 basis point of good book provisioning. This means you get a return on assets of 3.1. To my mind, given that you also have liquidity with infusion of credits, and the credit deployment will take some time over the next few quarters, the NIM will continue to hold and improve, and the fee income, like I said, in the H2 tends to be superior. So I think we should be able to hold and grow from where we are at 310 basis point on return on assets.
So maybe 3.3 or 3.5?
Unfair for me to say, but obviously I think you look at our past performance is a great indicator of where we'll land and how we can demonstrate and build from here.
Sure. And on adequacy, where are you now post the raise? Because at the end of Q1, you're somewhere at 21.5. So post the raise,
we are at 21.5. But if you take a look at the equity infusion which happened last week, it gets you to about close to 25%.
Okay. And how long does that last you?
I think we have enough growth capital for next 2 to 3 years. We are a fairly profitable business, so it allows us to leverage profit to grow further. So I think we have enough growth capital for next 3 years.
Got it. So no dilution for 2 to 3 years. Great talking to you, Mr. Mehrotra, as always.
It's always brilliant talking to you. Pretty sharp. Thanks.